Seema, thank you so much for joining us here at IMpower. It's great to see you. What would you like to say at the moment in terms of consensus on the macroeconomic outlook? What are you seeing?
Well, the interesting thing is there is a lot of consensus. You have three key themes which seem to be threading all investors together. You have expectations for a global growth slowdown, particularly in the US, the coming end to global central bank tightening, and then inflation coming down. So that is the consensus. Now, I wouldn't say we completely disagree with that, but I have to say there is no safety in a consensus view. There is no safety in numbers, because ultimately, if everyone's positioned the same way, even one slight shock can really adjust and affect investors. The other part of this, which is quite concerning, is that although there is consensus, there is very little conviction. So when you think about macro forecasts for the US example, investors are varied in terms of duration, start date, depth of recession. And that can be quite concerning. So if you have consensus but very little conviction as well, it does mean that investors tend to be a little bit paralyzed by fear, unsure of what they need to do. And unfortunately, that does affect flows at this stage.
So given what you've just described there, and if there is a risk inherent in that sort of consensus play, what would you say people should be focused on and should be doing in terms of strategy in that environment?
So one of the things that can happen when there is very little conviction is that people can be very swayed by small headlines. You see one movement one day, another day, and you do get a number of investors who are very keen to keep adjusting their portfolio. So that's one thing that you do need to avoid. So in terms of focusing, you have to focus on the key themes, which is still what is happening to growth, what are the central banks going to be doing, and what is happening to inflation. So when it comes to growth, I think the key thing that investors should be looking at, forget the retail sales numbers, industrial production, really focus on the labour market. Jobless claims are going to be your key leading indicator at this stage. The other part of this is understanding what central banks are going to do, because actually the uncertainty of not knowing when the Fed or the ECB or the Bank of England are going to stop rates is really what is upsetting investors. So to have a clearer view, you have to take a view on inflation. Take a view on inflation, but also have a view on central banks speak. What is their fundamental view? What is their conviction? What are their views? And that's really going to guide investors. For us, we do not expect to see any central bank cuts this year, and that has to be key. But importantly as well, investors can get a little bit obsessed with the idea of when is the Fed going to start cutting rates. You actually don't need the Fed to start cutting rates before you can start investing. Markets will start to turn up once they have certainty of where the next path is going to be. So that is going to be key.
There has been an idea discussed here at IMpower that actually we're going back into a sort of more normal period, bizarrely, that actually the last sort of period after the general financial crash was actually an anomaly in itself, in that there was easy money and rates was as low as they were. What would you say about that idea? And actually this is people readjusting to what is back to a new normal.
So I think that is true to some extent. So the last 10 years were very abnormal. The idea of quantitative easing, something that hadn't been viewed before the last decade. Having said that, a number of investors have actually forgotten what it was prior to the past decade. So they have become very accustomed to this idea of low volatility and high returns, essentially being able to make positive returns without actually having to put too much attention to the market. So if you look at over the next 10 years, it is more normal, but it does require a change in mindset for a number of investors. And this is where deeper analysis, diversification is going to become more important, because you're looking at a next decade of high volatility and low returns.
What are the key things to that good analysis going to be? Is it going to be adoption of really good AI, or is it going to be better teams?
It's a bit of both. So you're right to say AI, because you cannot forget about AI. It is important, though, not to get swept along with the idea of short-term productivity gains. AI is incredibly important, and it will be fundamentally changing of our future. But the productivity gains are not going to come by in the next 6 months or so. This is a multi-year process. So investors have to be ready for that uncertainty and the time it will take for those productivity gains to come through. In terms of analysis, deeper analysis into companies and sectors, it's not just about broad trends. So understanding not just, again, sectors, but also country-wise. We have a general view amongst global investors that the US is the place to be invested. But actually, you do see more and more opportunities in a number of emerging market economies, which actually over the next decade, as they are showing more consistent and fundamentally strong monetary policies, they will be good investment cases.
So you'll need really good key expertise in perhaps specific geographies in terms of your teams too.
So having a bit of local knowledge is very, very important. So at Principal Asset Management, what we have done is we have tried to bring in some of our local teams into the global footprint. And that does mean that local investors get the ability to have access to some of our more global products, but also our US investors and European investors have access to the emerging market products. And that has to be key. Local knowledge is what's going to direct a lot of the investment process over the coming years.
So with all of this in mind, in terms of a general view, what would you say about how to prepare portfolios for those, long-term kind of good prospects now in that environment?
So the first thing to keep in mind is that at the moment, a lot of, as I said, investors are a little bit paralyzed by fear. What we are anticipating is that as the economy does slow in Q4, actually that is not the time to be scared and be running away. That is the time to be investing. So as you get closer to Q4, that is the time to be prepared to get your assets ready to deploy into really the areas which will perform well in a market, in a strong market. So small cap, high yield, these are the areas that will do well. That's the short-term case. Over the next 5 to 10 years, when you have a high volatility, low returns, you have to think about markets outside of your traditional equities and fixed income. To us, private markets, yes, they will be challenged in the next year or two, but actually if you're looking at over 10 years and you need higher returns, those are the areas that investors need to have greater focus on. And for companies like ourselves, you have to have deep analysis, not just in public markets, but also in private markets.
Seema, great insights. Thank you so much for sharing them with us here at IMpower.
Thank you so much.